Well, thank you for that, and welcome to this panel discussion on long-term investing. So I have a fantastic panel. It's at the far end, Angelien Kemna from APG in the Netherlands, and then Hiromichi Mizuno from the Government Pension Investment Fund in Japan. Amanda McCluskey from Stewart Investors, and Paul Smith, President and CEO of the CFA Institute, and they all have wonderful resumes that you can read more about in your conference app. So I wanted to start by asking a more sort of provocative question. Is this issue of short-termism really a problem? And some observers, for instance, say that, well, if you look at what investors are actually doing, they're willing to pay billions of dollars for companies that never made profit, just on the basis of expectations of some profits far into the future. There are well-known cases like, internet startups, but on average, investors seem to be overpaying for companies where the expected cash flows come far into the future. So value companies seem to be outperforming growth companies over the longer term. So they say this issue that investors are just focused on the short term is a myth. So I'd like to start there. Maybe Angelien, is this a myth? Is it true that investors are putting too much emphasis on the short term, or is it maybe the other way around? They're putting too much faith in sort of long-term expectations of future cash flows.
Okay. Thank you, Martin. It is a provocative question, indeed. I think we have many short-term investors, and actually increasingly so, and I'm using one argument that really worries me a lot, increasingly so due to regulation. I think Solvency II has made insurers who were our peers in long-term investing into short-termism. And you could say, is that bad? Yeah, that is bad for the real economy. Because they can no longer, as they did, invest in illiquid assets. Solvency II punishes them too much to invest in illiquid assets like real estate or infrastructure, and that hurts the economy. And I think that's one answer. So I would think that short-termism is bad if it's caused by regulation. On the other hand, if you have various market participants, one short-term, one long-term, you can make use of that. So I don't think that is too bad. And the examples that you mentioned from the companies, probably one is a value investor and another, we still have too many momentum investors, I think. And they will see that in their returns.
So it's more playing momentum than actually long-term investment views.
Yeah, and I would wish there were more long-term investors. So I myself have been lobbying a lot in Brussels to prevent European pension funds to get under the same regime as insurers. Because then, most definitely so, also the pension funds will not be able to participate in the Juncker Fund. Because that will be a too harsh penalty on capital. Yeah.
So let me open this question to the others. Is long-term investing really lack of long-term investing really a problem?
I think it's a huge problem, particularly in equities, which is the area that I work. I think pension funds are doing some great stuff in terms of asset allocation that are getting a longer-term focus. But in equities, let's look at the numbers. I mean, in 1940, the average holding period of a company was 7 years. In 87, it had dropped to 2. And now it's around 6 months. I mean, if that doesn't tell you there's a problem of short-termism in equity markets, I don't know what does. But the other thing that I'd point to is a sort of interesting anecdote. Everybody's probably read the book Flash Boys.
Yeah.
I mean, it's remarkable in terms of the insights of the problem of short-termism, particularly in relation to high-frequency trading. And I think it's also then interesting and testament to the fact that short-termism is a problem, that the solution is the IEX, which is the new stock exchange that's just been licensed. And the new stock exchange is going to provide openness and transparency by providing a 350 millisecond speed bump. I mean, if that doesn't tell you short-term is a problem, that we're talking about 350 milliseconds providing transparency and openness to a stock market, I mean.
But does it necessarily mean that investors are more short-term? You could argue that this is making the marketplace more efficient, but you're shaking your head, so I disagree. I'm trying to
I think
Be positive about it.
doesn't it? I mean, the long-term, short-term debate depends upon what the problem is that you're trying to resolve, and the problem that a lot of people in this room are trying to resolve is environmental degradation, financial inclusion, financial literacy, perhaps, and those are solutions, or those are challenges that require a long-term investment focus. And we had a couple of numbers bandied around today that we need, whatever it is, 7 trillion to 15 trillion US dollars of investments to fill those needs, and those are long-term needs. But as the joke runs, you know, the long term is just a collection of short-term events. So I don't think it's as simple as just sort of saying short-term is bad, long-term is good. It's a question of horses for courses. The investment industry should be, I think, better structured, better enabled, perhaps through regulation as well, to fill some of those long-term needs that society clearly has. The challenge today is that the structure of the investment industry, for all sorts of reasons, is not geared towards meeting that 7, 10 to 15 trillion dollars of investment requirement. And so that's really, it's not whether, as I say, it's not whether long-term is good or short-term is bad. It's how do we, if we believe that those are challenges that the world faces, how do we restructure things to enable that capital to be found and to be properly invested?
So, Hiro, you've been in various places in financial centers around the world for a couple of decades, and now you're back in Japan and chief investment officer for a fund where you have an investment horizon of 100 years. 10 decades is what's said, I think, in your sort of investment policy. So how does this look from your perspective?
Well, I think looking at statistics, the U.S. companies and the Japanese companies, some of the companies have highest R&D expense per their revenue recently, and I speak to the corporate executives, and it's very rare to meet the executives who are really incentivized or motivated to make this quarter number higher at the expenses of like a 3-4 year result. So I think as a whole, market has been efficient. So market takes some short-term trader. Extreme one is the AI who trade a nanosecond, to people like us, willing to hold like a 25 years to 100 years in equities. So, but as a whole, I think the market seems to be efficiently controlling the companies, like sort of business horizon, or the commercial horizon. And given our about $600 billion US dollars global equity portfolio, we manage about 20% through active managers and 80% through passive managers. So just from our perspective, we are happy for our active manager to trade on a short-term cycle. As far as our passive investment will be focused on the sustainability or like a long-term return of the company. So I think we cannot really tackle or actually force all the different type of investors to have a same investment horizon. Rather, people tend to have a different investment time horizon, but as a whole, it works, and then I'm happy. And one thing I just want to say is recently, like a short term has become such a big buzzword. So when we spoke with the other, corporate managers, they tend to even discredit active management of the portfolio. So I said, that's not exactly what we want. We totally agree that the some of the investor as a whole, we should have a long enough investment horizon in mind when we make an investment decision, but you really cannot dictate or expect every single investor will behave in the same way.
And you would expect a well-functioning market to have different types of investors. So, but is it true that can more short-termism from some investors create other or new opportunities for those with a long-term orientation?
Yeah. I think that is certainly true, because some of the effects that you mentioned has created a whole low volatility sector who actually plays against those who over-exaggerate and overvaluate all these hypes, with the exception of, because you saw me nodding no, with the exception of high-frequency traders. They do not provide liquidity. They jump on the bandwagon, see what you're heading at, and we are just too big. And if you have maximum transparency, which is required, then it's very simple what is happening. I think as a counteract, and again, that's a good thing, because you notice that the cost of market impact increases. So it also creates a lot of innovation, because, for example, on your quant models, you can look at transaction cost, including market impact. You can do that exogenously, but you can also include that in your models and see how far you get by bringing down your turnover and therefore your market impact cost. We've seen that with our quant portfolios, and turnover and therefore implicit market impact cost have come down quite a bit. And I think for a long-term investor, more and more, not only your management fees, but also the way you have this long-term horizon, so also the way you structure your strategies, market impact costs. Markets are getting less and less liquid, so market impact costs are becoming a hidden cost, which potentially hammers your returns. So that gives way to new strategies, and sometimes also old strategies, because just as a side, the other day I discussed with the CIO to think about maybe go back to good buy and hold strategies for credits. Why make that into quant and maybe go back there? So I think being aligned with the asset owner, thinking about those costs and generating new low vol criteria, but also good old ones, I think makes you think about how you should look at long term, given market circumstances, given regulatory circumstances.
Also that, long-term investing is hard. I mean, you think about Hiro's problem. I mean, 100-year time horizon, with all due respect, that will probably see you out, and you will you'll not be around to reap the benefits of that 100-year investment return. So for trustees, for regulators, long-term investing behaviorally is very difficult, but it's also very difficult from a metric perspective. And it's also virtually impossible in an environment that we live in today, where our profession, in inverted commas, is not trusted by anybody. If you think about a long-term relationship, the benefit of the basis of a long-term relationship is trust. And our industry, as Mr. Blood said this morning, has an existential crisis. Effectively, it's not trusted. It's over-regulated as a result, and therefore, within that framework, it's very, very difficult to conduct long-term investment because there is no trust bond between the investor and the manager.
But that's interesting, because the mistrust has probably come about because of short-termism. I mean, if you look, 2009, Paul Miners came out and told us about the problems of short-termism and what it was leading to in terms of a lack of stewardship and a lack of behaving like owners of companies, and companies are becoming these zombies wandering in the night. In 2010, Mercer came out with the report looking at 900 supposedly active long-term managers, and 2/3 of them had turnover significantly higher than they should have, some 150 to 200% higher than what they should have been to be long-term active managers. K review came out in 2012 telling us the exact same thing. 2014, 46% of the 237 active managers reviewed were found to be nothing more than closet benchmark huggers. I mean, of course the fund management industry has lost a lot of trust from the companies that we invest in and the stakeholders that we're ultimately set up there to serve, that being the beneficiaries.
So the discussion we've had so far, I think now we're touching into many areas. So it seems to me that when you're describing long-term orientation, you're talking partly about asset allocation, partly about sort of an investment approach or an analytical approach, and partly more about the culture that you have. So is it all of these three, or is it primarily about asset allocation? Is it about that if you're a long-term investor, you have a different type, hold different types of assets, or is it that you behave differently as owner of those assets that you have?
Well, when excuse me, when we come up with our policy asset mix, we take a very long-term view. But at the same time, we disclose our quarterly number to public, and we recently reported like about just $50 billion loss, which is peanuts, but nobody laughs, so I'll choose the subject.
It's a hard day.
They're just envious.
I'm glad there are very few
to
Japanese
shrug off.
pensioners, or maybe everybody's Japanese pensioner. They cannot laugh at it. Well, but in terms of percentage, 3%, volatility, which should be a part of our daily business. But the problem is, every time we report the quarter result, it just make a very, very big public debate. Yep. So I don't think it's just a GPIF problem, but for a lot of like a public asset owner, their stakeholder management or public relation, media relationship has been really a big headache. And on one hand, we deal with those kind of like maybe short-termism, and on the other hand, we are trying to encourage asset managers not to fall into the short-termism, and also we are trying to tell the companies not to fall into short-termism. So there's a disconnect between the way everybody disclose their performance and everybody how they are evaluated their performance. So we have to work out that how to optimize all those like evaluation chain in a way. So without it, we were going to struggle all the time.
I think cultural alignment is absolutely essential, and as Hiro said, you've got to start as an asset owner or as an asset manager with a system of beliefs. What is it that your investment business genuinely believes in, and then drive your process and people off that. And where you're allocating money out to third-party managers, you've got to ensure that that belief system gels, or else you're going to have the disconnects that
Maybe I can add that. I think it helps us a lot to indeed work with the asset owner to continue to internalize. We're big enough, we can scale, we can low cost, to internalize a lot of the strategies. That helped certainly because that was a long-term process with the asset owners themselves. To associate yourself with the asset owner, what their goal is. Pay small pensions every month, 600 to 800 euros today, tomorrow, and for the next 30 years. I think it's good to get that sense of feeling. And as an example of how you work together, it is something that trust has to be built up every day. And as an example, it took us quite a while to get us going with the new ESG strategy, because I think as the APG felt that they were doing a lot, and ABP said, but we want you to do more. And so it took us, Xander, a year to get aligned, which was actually extremely good. It may seem like a long time, but that's what it needs, and to be completely clear about what you want with each other. And we're taking, I was telling you, I'm going to tell that, so I'm going to announce it now, because we take it one step further here together with PTGM and other Dutch pension fund asset managers and some Swedish, to go one step further with the measurement of the sustainable development investments. Because if your client wants you to do more, then it's easy to say, we do more green, or we do more social impact. Okay, first of all, we need return. But then we have to show, and it came around a couple of times this morning in the discussions, it's good to do something with impact. And we've looked at the sustainable development goals that are out here in the exhibition and try to translate them into investments to have impact on sustainable development goals, and try to come up with metrics, or at least with a discussion, to make sure that you can showcase afterwards that you not only have a good return, but actually also have impact. That's not easy. It has a call out here. It's on the website. Tomorrow, Elze Bos of PTGM will elaborate more on that. And we call upon asset owners and asset managers to help contribute and get the metrics going.
Great. Look, this ties in very well with some of the announcements we made yesterday about the PRI workroom. Let me also advertise a little bit for our asset owner guidance, which addresses the issues that you raised, Paul, also about how important issue of investment beliefs and aligning beliefs is through this change. So that's a guidance that's out on our website, and it's a great new, relatively new document from us. Secondly, on the Sustainable Development Goals, which we obviously will have to work on at the PRI as an organization and help those investors who want to engage like you do, finding out how we can translate those into meaningful activities for investors given their fiduciary responsibility and their mandates. So that will be an ongoing work, and
so
it's great to have you on board in this work. But so a couple of things so one aspect of this we'll come back to maybe is the question of whether long-term investing really has something to do with asset allocation more at the societal level. So you raised the issue that, how do we align investment activities with societal goals in a broader sense? And maybe the issue of short-termism is that we have, at the societal level, too many short-term investments and not enough investments in the longer-term infrastructure. And that goes back to your first point about regulatory constraints on some large institutional investors. So is this at the heart of this short-term, long-term debate, that at the societal level we're under-investing in infrastructure, green energy, other things that we know we're going to need for the future, and over-investing in things that have more sort of short-term benefits? Is this what you is this a link to the short-termism debate?
I would certainly say so, yes. Regulation prevents us to do more. And we've seen the example with the insurers. And even regulation like central trading of derivatives urges you to hold on to more cash or liquid assets. So it is, at least in Europe.
Well, not just in Europe. But Hiro, you're not constrained by Solvency II, so you could count yourself very lucky, because that is... But
so you can
how do you think about this issue of, as a long-term investor with an investment horizon of 100 years, does that tell you that you as a fund should be more invested in those longer-term infrastructure opportunities that have that type of time horizon?
Well, I think we started alternative investment program just last year, and we so far created one partnership with the Canadian Pension to invest into brownfield infrastructure. But I agree with you, and infrastructure is long-term, quite a suitable investment for pension program. So we are trying to expand that infrastructure program. Also, infrastructure is less interesting if we don't look at greenfield infrastructure. So But the problem with the greenfield infrastructure is, particularly I'm concerned about the ESG consideration when they build a greenfield infrastructure, because usually in those countries where they need first infrastructure, they have to make it cheap. So there are a lot of political and also commercial incentive to use no clean technologies. So I've been advocating, I've been calling for the cooperation among asset owners, because on one hand, everybody seems to agree that it's good to pay attention to sustainability or like a low carbon emission, particularly with respect to the infrastructure. On the other hand, we compete for the opportunities. And sometimes we do it blindly because we invest into the fund, and we just don't have a control over which fund ended up or GP ended up investing in. So I think as an asset owner, as a community who agree to this kind of responsible investment principle, have to make a statement that we are not going to finance those type of the infrastructure, regardless of the commercial viability or commercial feasibility or whatever attractiveness of the cost basis. So that's my view on the infrastructure investment.
Going back to when you presented your initiative, Angelien, you also framed this as a way of communicating with stakeholders almost. So I wanted to come back to this issue, and it relates to something that you said, Paul, also about the whole chain and thinking about the beneficiaries, the asset owner institutions, the investment managers. How do you sort of align the long-term orientation across that chain? And that takes us into this area of performance metrics, which is, in a way, communicating about performance is the main channel of communication you have with, for instance, your beneficiaries. So how should we think about that communication in this context?
Well, I think those are great questions, Martin, and I think it cuts at financial literacy within our societies in general, because, to Hiro's point, no matter how brilliant a job he does in the long term, his end beneficiaries are looking at him quarter over quarter. So if he drops 50 billion in a quarter, he's got career risk, he's got all sorts of other challenges that are going to come at him. So how do we create an environment that includes all investors out there, and very definitely the retail public, to be better educated about what capital markets and investment are for? And the challenges that our industry, going back to Amanda's points earlier on, our industry has boiled investment down to a series of quarter-over-quarter benchmark performance challenges. And so we've led ourselves into this trap of short-termism. And now we're faced with trying to educate the public in general, as well as pension plan trustees who are often extremely poorly educated. We have a program for pension fund trustees that is about 70 to 80 hours of study, and the average pension fund trustee has responded that they're prepared to do only 7 hours of study, not just a year, 7 hours of study, point final, throughout their entire lives. So when you're faced with that as a backdrop, trying to convince people of the benefits of long-term investment is I think really challenging. We've let ourselves in that, so I'm not trying to duck the responsibility for that. But how we get out of that is, I think, a multi-year educational challenge that, again, to Hiro's point, if we don't all come together to try to combat that, I don't think we're ever going to get out of this mess.
I think finding a way to communicate what we do and performance and redefining that is critical. Ultimately, we need to redefine what our role is as participants in the finance sector. For us, ultimately, it's about allocating capital to the most productive parts of society, and doing so in a way that delivers sustainable development outcomes, particularly for the world's poorest and most disadvantaged. So I think bringing some ethics back and talking about ethics in the broader sense, not ethical investing, but bringing some ethics back to the finance sector and getting people to come and work in the finance sector who have that sense of purpose, I think will make a huge difference. And then we will come up with the new ways of communicating performance.
So that's a challenge, obviously, and I think we talked about sort of the asset owner institution like the GPIF and how you communicate with your beneficiaries and sort of educate them about the long-term orientation and the fact that in order to achieve high long-term returns, you are willing and you have to live with some higher shorter-term volatility. But we also touched briefly on another aspect of alignment, which is from the asset owner and down to the investment manager. And so you're investing for 100 years, but obviously you're not employing an investment manager on a 100-year contract. So how do you think about that relationship and how you can align your long orientation with the activities of the investment managers who are investing on behalf of your fund?
Well, we are still in the middle of improving our sort of message or the rule of the game that those managers have to play for us. But the one direction I'm trying to make it clearer is that, as I said at the beginning, we have active managers and passive managers. Passive managers, we are encouraging them to spare more resource for the engagement with the company, with the long-term long-term time horizon in mind, because those people will be big owner of the company for a long time. And on the other hand, active managers, we are trying to encourage them. If they think 3 months, sort of trading actually works the best for them to create alpha, I'm not discouraging them to do it. So I think active management, we basically trying to tell them to prove their performance shorter period of time, but the passive has to be longer. So I think all this mismatch is very difficult to manage, but we are trying to make the rule of the game as clear as possible. The other issue with the active manager is that whether use of the benchmark itself is really relevant or not. And unfortunately, GPIF has given the mandate from the government to create the alpha in each asset classes. So we cannot be totally off the benchmark. But still, we encourage the active manager to propose us with the non-benchmark strategy. So I think that from our perspective is just to make the market as a whole more efficient. So that's one thing. And the other thing is, actually, I want to ask a question to other panelists or maybe the audience. What's your definition of long term? Because I'm confused because a lot of our active managers try to pitch to me saying, we are not short-term investor. We hold 16 months. Really? Okay. Finance 101 says that anything longer than 1 year is a long term, but probably that's not what it means. So what kind of a time frame we actually talking about?
You can think about that question because I'll be inviting you to comment and give questions in a couple of minutes. Let me give you my answer. So, and from sort of experience of the Norwegian fund, I think what we found a useful working definition is that you have the capacity to hold an asset. So you're never forced to sell. And I think that is what distinguishes, a regulated pension fund that has to, because of risk limits and constraints, you're forced to draw down the risk in your portfolio just when you've lost a lot of money because your buffers are smaller. That is a constraint on your investments that forces you to act in a specific way under specific circumstances. So from that perspective, I would say, for instance, a sovereign wealth fund, which is outside of those types of regulations, has the opportunity to be contrarian. And you can then rebalance your portfolio and buy assets when others are selling. So, but I'll be interested to hear some views from the, but maybe it's not a question of whether you hold an asset for 6 months or 6 years or 60 years, but whether you have the capacity to hold that asset for as long as you want to hold that asset without any external constraints. But Angelien, I'd like to come back to implementation of your strategies and this issue of internal versus external. So one concept that has been sort of gaining currency and people are talking about more and more is sort of moving from transactional relations to more sort of longer term trust-based relations. And one aspect of this is, of course, the relationship you have with external managers. And I understand that you've done something a bit unusual, perhaps, is getting the external managers inside your own organization.
Yeah, I think.
So how do you think about those issues?
I think that long before I was there, I think ABP made a smart move to internalize quite a bit. And it also internalized the external managers. And from the investment philosophy that we have is that you look for various reasons to add to your portfolio with external managers. That can be, again, a capacity enabler. We use some passive, not much, because you still lose some basis points compared to quant, just as capacity enabler. We use some externals as our own internal benchmark. You can imagine that having quite some quant strategies, for example, sometimes quant just doesn't work for a year. And then it's good to know that some of the other top quants also perform less or not. And of course, the usual suspects is you can't bring about a good internal team, like we weren't able to do with emerging market debt. Then you have no choice. If you want to have the asset class, you do it smart. Or you have internal managers that you decide do not perform well enough what you expect. And I think there are so various reasons to add on to the portfolio, which make a lot of sense because external managers are a lot more expensive. In large portfolios, it's hard to move the needle. A 100 million American small mid-cap, how brilliant it managed, it doesn't make any sense. So cut them out. So we cut back dramatically on external managers. And we negotiate, Xander told in another session, the Dutch asset owners are looking a lot on cost. There are many external managers who do not want to do business with us and kick us out. Well, that's where you get the limit. If they kick us out and we wanted to get out, that doesn't really matter. But I do think it's a completely different philosophy. And you build your building blocks optimized on risk, return, impact, cost, not only the cost of management, but also market impact and sustainability. So those are the drivers. And again, we do that quite intensively with the investment committee of our 4. We only have 4 clients, 1 very little and 1 very large, and 2 in the middle. And we have this, well, weekly relationship. It is as if you're the asset only we do it for a little bit more than 1 client. And our costs are coming down dramatically without losing performance, of course.
One thing I was going to say on that is there's only one benefit of old age, and that's that you see everything twice. And when I came into the industry, everything was internalized, and then we went through an outsourcing, and now we're going back through an insourcing phase again. I was in Canada recently, as Hiro was talking to all the Canadian pension plans. There isn't a single one of them now who uses third-party managers. They've all internalized their asset management capability. They're bypassing the public markets. They're doing much more in direct investment than before. And these things are a response to an industry that has priced itself out of the market, and to your point about relationship management, has failed to align itself with its end clients. And so the logical response to that is to insource. Ultimately, that will correct. And I think the only thing that I would say about this debate is not to assume that there's some sort of magic bullet between insourcing and outsourcing. It's a cycle like any other, and I'm sure the asset management industry will figure out that it's overpricing its services, that because so many asset managers are owned by the public, they're publicly quoted companies, they have a misalignment of interest in terms of what they're trying to do for their shareholders and what they're trying to do for their investors. And that's the dirty little secret at the heart of our industry, is that they're trying to serve two masters at once and failing to do it in many, many cases. So I think this is a cyclical phenomenon that will certainly see me out in my career, but I'm sure for a young man like you, you'll see the outsourcing cycle
we'll see.
come around again.
I'll open up for questions now. So just one final question to you from me while people get ready. And there are some microphones, someone with microphones here. Does this change in the sort of insourcing of management, should that make it easier for asset owners or investors to apply sort of ESG criteria in their investment? Is that one aspect of this, that it's easier to define sort of ESG criteria and internalize those because you have more direct control over the investment process?
I mean, I don't think it makes any difference if it's an internal or external manager. It comes down to the integrity and culture of the people who are managing those assets. And if they believe that it's their role to allocate capital to the most productive parts of society, to invest for the long term, and to behave like owners of companies, whether you're in a pension fund or in a boutique funds management business, I agree with you with the misalignment that can occur. If you're in a well-aligned and a good incentive structure funds management business, I think it can be done in both.
Well, first of all, on the top of, we are not allowed to make any in-house investment in the equity, but I actually think, or I'm not that optimistic to build an internal team which is as good as the external money managers. So I'm actually really focusing on how to reduce the agency cost or conflict of interest between asset managers and also asset managers and companies or the project. So I'm not really, urging my team to focus on how to work on those, agency issues to optimize whole the system and making us as probably the world-class fund of funds or manager of managers. So I totally agree that there's a lot of benefit to take the investment team in-house, but I think at the moment we are focusing on how to do it through the external channel. So.
And for me, the answer is yes, because you can tailor-made. I think that's important. It is the policy of the trustee. They come out with how their beliefs are, and yes, it's hard work, but I think ultimately on the trust side, it has your benefits. Yeah.
Great. So where is the first? It's back in the back, so please identify yourself.
Thank you. Rick Stathers, CDP. Two recent reports, Mercer's Investing in the Time of Climate Change and CISL's Unhedgeable Risk, both identify the long-term implications of climate change to portfolio returns, neither of which provide a positive picture for us, the pensioners of the future. Could the panel explain what efforts their organizations have taken to assess the long-term financial risks that climate change poses to financial returns, the findings of any such research, and how this has influenced their investment process? Thank you.
Thank you. Great question. So climate is obviously a long-term, it will play out over the longer term. So maybe I'll start with you, Angelien. How do you think about climate risk in your work?
That's a long-term trend. And long-term trends are typically discussed over all the asset categories themselves, and is a sector approach, because some sectors are more involved than others. And it plays out specifically in individual picks. And the idea is to not as much do negative calls and exclusions, but to invest in the positive potentials of those companies, whether it's credit, private equity, or real estate, or plain vanilla equities. We tend to play out the positive companies that we think have the trend right.
Yeah. Hiro, is that
Climate change.
Yeah. How does it affect your thinking on the investments?
Well,
in the fund?
I mean, through the debate of the fiduciary duty and et cetera, I had a big debate with American, the lawyers. And what I said is, our pension is designed to be sustainable for the next 100 years, and really don't see any point in our great-grandchildren will receive a pension payment in full, but they cannot walk outside because of the climate is not allow them to play outside. So that's where my thinking comes from. But when it comes to our investment strategy, we are now calling for the proposal for ESG indices. And we are trying to approach the climate issue, which is very long-term agenda, but we need to bring that or interpret that into the daily investment activities. Otherwise, it's just not going to become a sustainable business for us. So I think it's a very, very long-term issue, but we really need to use our brain to make that into or take that into daily investment practice. And one possible solution, what we came up with is creating some, ESG indices, which actually probably positively screen the company who comes as a positive technology and et cetera.
Okay. And we would agree with Hiro. What's the point of allocating people's retirement savings to companies which are completely trashing the environment in which these people are going to retire to? So it's fundamental. It's a fundamental part of our investment process in assessing the quality of management, quality of franchise, and quality of financials. Is what is the climate risk, and how do we ensure that it's mitigated? And as a result, we have no exposure to fossil fuels.
Okay. Next question. There in the back.
Thank you, panel. Anthony Hobley, Chief Executive of the Carbon Tracker Initiative. When we talk about long term, I wonder what the other sort of 99% of the financial community are not here think about that and the extent to which they disregard it. I mean, I think everyone in this room gets why we need to think long term and what the implications of that are, but how do you get the attention of the rest of the financial markets? Don't we need to start demonstrating that a failure to look at the long term results in real financial risk now? So for example, if you'd put your money into US coal equities 6 or 7 years ago, you'd have lost 90+% of your investment. If you'd put your money into European utilities 10 years ago, you're down 40 to 60% now because they made the wrong bet, and the major European utilities ignored the move to renewables. Again, oil and gas companies over the last 3 or 4 years, or certainly a couple of years, because of their investment in high cost, capex projects, their share price is suffering, that they're borrowing horrendously now to continue to pay the dividend. So these are manifestations, real financial risk that's starting to result from a failure to think long term. I think the more we talk about long term, I suspect many in the financial markets will say, well, come back to me when that results in real financial risk. The reality is it is creating real financial risk and loss now, and don't we need to talk more about that so that this is actually taken seriously?
Yeah, I absolutely agree. The challenge with that, though, is that the value proposition of talking about long-term investment is a very difficult one to articulate. I mean, everybody knows that if you go back and look at the Dow Jones Industrial Average, whatever it was 70 years ago, there's only 1 or 2 stocks, I think, that are still left in that index. The others have all died. So you can come up with lots of examples about the long term, but the reality is people don't think that way. And so I agree with you. It's an educational, it's a discussion problem that we have to talk and to try and prove it. And I look at our profession and I think, when you think about investment management and you compare that to, say, other professions like a doctor or a lawyer, we have this real challenge. You go to a doctor and a doctor kind of cures you within 2 to 3 weeks or kills you, basically. So you know your doctor is good or bad. it's very hard for a long-term investment manager to convince clients that they're doing a good job over the long term when quarter over quarter or annual performance might be poor. And so it is an educational issue that I think is not intractable, but certainly one that is very, very difficult to overcome, and one that we certainly do ourselves a disservice by the way our industry is structured at the moment, which is all of our public pronouncements and the way that we present our businesses are geared towards the short term.
I think David beautifully articulated this morning the business case for sustainable investing and long-term investing. And I think there's a raft of people in here who are passionate long-term investors and stewards. I'm a bit obsessed with Italy at the moment, and I just spent a month there trying to learn Italian, did a terrible job of that. But I came away thinking, we need to start a slow finance movement, like they have a slow food movement in Italy. And we need to regain the discussion of the role of the finance sector and the positive role that we can play. And I think that will start to address a number of the issues.
We'll have a discussion tomorrow on some aspects of climate and climate policies for investors. So I'm sure we can get back to some of these issues then. We had a question there.
Sure. Emma Hunt from Hermesios. Really quick question, because we've had 2 long ones. Look, we're moving into a VUCA environment, volatility, uncertainty, complexity, ambiguity. It can cover climate change, but many other issues as well. Is it going to help or hinder long-termism?
So are we being distracted by all these short-term events? Is that a risk, that managing all this short-term volatility, it will just take away attention? So let me start with you. Are you distracted by Brexit, by all of these things that are happening, and does it take your attention away from all of these longer-term issues?
Yes, certainly. It takes a lot of extra explanation, a lot of extra management. But in the end, since we have with all the clients 20-year track records, and we've gone through a whole financial crisis where we kept our strategic asset allocation together with the trustees, is their allocation, but we kept it more or less constant, and we were able to reinvest in equities. So by continuously explaining what's going on, that costs the time, but you don't see, because you live through a serious crisis, and it's going to stay volatile. I'm dead sure of it, but it has been volatile for more than 30 years, but now it's moving very quickly. I am scared about a credit reversal. If credit spreads go up, then there are too many people for a too illiquid market, and I'm not very sure what would happen then. But that will also be a spike, and keep calm. We've lived through enough to.
So one of the large funds here, GIC, in their annual report, they don't report quarterly returns. They just report their rolling average 20-year returns. So would that help you?
From last year, we disclosed both our performance for this year and the last 15 years. And I keep an eye on how the TV camera focus, but they only focus on annual results. So hasn't been very successful. But and maybe just shifting towards just the rolling numbers, probably not going to get a public support either. So I think in many businesses, increasing transparency relate to more trust from customers. But in this industry, sometimes works backwards, and we get backfired by increased transparency. So
you need to build that trust first before you can start changing the metrics.
I think so. So I think for something like a Brexit, we don't trade at that event. But if we can hedge a little bit and smooth out our volatility, it probably just contribute to get the more trust from the public. But at the end of the day, I totally support if everybody in this room agree that every single pension fund manager in the world only report 15 years rolling numbers. And I can say that's global standard. So
that will help. Well, Our time is up. This has been a very engaging and interesting debate. So thank you to all the panelists, and thank you for all your questions and for your attention. That's
Thank
all
you.
the time we had.
Okay.
Thank you.